The market is not crashing because of bad news. It's not crashing because of interest rates or wars or presidential elections. The market crashes because of human nature, because greed turns to fear in a heartbeat, because amateurs buy tops and professionals distribute into strength, because the crowd always, always does the wrong thing at the wrong time. I've made millions recognizing this pattern. I've lost millions ignoring it. And I'm going to show you the mechanical signs that appear every single time before the crowd realizes they're holding the bag. By the end of this video, you're going to know exactly what every market looks like right before it crashes, not through theory or prediction, but through the mechanical, observable signs that have repeated throughout history. You'll learn to read the tape, the crowd, and your own psychology before disaster strikes. And I'm going to be straight with you right from the start. I know what you're feeling right now. You check your portfolio every morning with a knot in your stomach, wondering if today's the day everything falls apart. You're holding positions that feel extended, but you don't know when or how to exit. Every expert says something different. Bulls say buy, bears say sell. You're frozen, doing nothing, while the pressure builds inside you. You've been caught before. You held too long. You believed the rally would continue. You watched profits evaporate and turn into losses. You swore you'd never let it happen again, but you don't know what you missed. Everyone's saying the economy is strong, earnings are good, there's no reason for a crash. But something feels wrong. You don't trust your instinct because you can't articulate what you're seeing. I understand all of this because I've lived it. I'm not speaking from theory. I traded through the panic of 1907. I shorted the 1929 crash and made millions while fortunes disappeared around me. I've been wiped out and rebuilt empires. I've studied every major market turn for 40 years. The patterns repeat because human nature doesn't change. Right now, you're operating in the dark, reacting to price movements you don't understand, following the crowd into danger. After this video, you'll see the market the way professionals see it, as a mechanical system of human behavior, readable, predictable in its patterns, exploitable, when you have the discipline to act against the crowd. Most traders think crashes come from external shocks, wars, bank failures, scandals. They don't. Crashes come from internal market mechanics: overextension, leverage, exhaustion of buyers, distribution by professionals while the public accumulates. The crash is built into the rally. The signs are there before the news breaks. I'm not going to give you indicators or formulas. I'm going to teach you to observe, to read the tape, the volume, the quality of buying, the behavior of leading stocks. I'm going to show you what the market looks like when professionals are selling and amateurs are buying, when momentum is artificial, when the rally is running on hope instead of genuine accumulation. I know what it's like to be certain you're right and watch the market prove you wrong. I know the sick feeling of holding through a decline, paralyzed by hope. I know the rage at yourself for ignoring what you saw. This video exists because I wish someone had shown me these signs when I was starting out. It would have saved me years of pain and millions in losses. So let me begin by telling you some stories. Real stories. Stories that will show you exactly what happens when traders ignore the signs that are right in front of them. I'm going to tell you about a man I met in 1928. I won't use his real name, let's call him Martin. Martin was a lawyer, successful, intelligent, careful with money his whole life. He started buying stocks in 1926, small positions in good companies: General Electric, Radio Corporation, United States Steel. By 1928, he'd tripled his money. I ran into him at a dinner party in September 1928. He was glowing. He pulled me aside, showed me his portfolio. "Livermore," he said, "I've finally figured it out. The market rewards patience and good companies. I'm going to retire in 5 years on these gains." I looked at his positions. Everything extended, everything bought by the public, everything distributed by insiders. I said, "Martin, have you considered taking profit? You've made a fortune. Lock it in." His face changed. Irritation, almost offense. Why would I sell? The market's going higher. Look at the economic indicators. Look at production. This is the new era, Jesse. Stocks reflect genuine value now. I tried one more time. "Martin, the tape is telling a different story. Volume's increasing, but prices aren't responding the way they should. The best stocks are lagging. The junk is leading. This is distribution. He smiled like I was a dinosaur. You're too cautious, Jesse. That's why you miss these long runs. I'm holding for the real gains. I saw him again in November 1929. His face was gray. He'd held everything. Worse, he'd bought more on the dips. He was wiped out. Plus, he owed money on margin calls. His retirement was gone. His confidence was shattered. I asked him, "What did you miss?" He said, "I don't know. The fundamentals were still good. The news was still positive. It just kept falling." I said, "Martin, the market was telling you. You weren't listening. You were listening to your hope." That conversation haunted me because I've been Martin. Not with those exact positions, but with the same psychology. Let me tell you about a time when I made the exact same mistake. 1906. I was young, successful, arrogant. I'd made over $1 million reading the tape, playing the swings. I knew the patterns. I knew when to get in and when to get out. Or so I thought. I was long Union Pacific, along with several other railroads. The position was enormous for me, over-leveraged, though I wouldn't admit it. The stocks had been climbing for months. My profits were substantial, paper profits that looked beautiful in my account. And then the tape changed. It was subtle at first. The rallies got shorter. The reactions got deeper. Volume on the down days started exceeding volume on the up days. The best stocks, the ones that always led, started lagging. My positions would rally in the morning and fade by the close. Every single day, the same pattern. Open strong, close weak. I knew what this meant. I'd seen it before. I'd written about it in my notes. The market was under distribution. The professionals were getting out. The smart money was selling to the dumb money. The rally was dying right in front of my eyes. But I didn't sell. Why? Because I was up. Because everyone else was still bullish. Because the newspapers were still printing positive stories about railroad expansion and economic growth. Because I convinced myself that this was just a natural correction within a larger uptrend. Because my ego wouldn't let me admit I'd overstayed my welcome. Because I'd been right for so long that I couldn't imagine being wrong now. I kept waiting for one more rally to sell into. Just one more push higher and I'd get out. I'd take my profits and step aside. The rally never came. The decline accelerated. What started as small pullbacks became larger drops. What started as profit giveback became break-even, then became losses. I held. I hoped. I justified. I rationalized. I told myself the fundamentals were still good. I told myself it was just temporary weakness. I told myself I'd be a fool to sell at these levels when it would surely bounce back. By the time I finally sold, by the time reality forced me to accept what the tape had been screaming at me for weeks, I'd given back $4 million in profit and dipped into a loss. $4 million. Gone. Not because I didn't know what was happening, but because I knew and refused to act on what I knew. That loss taught me something worth more than $4 million. The market doesn't care what you think. It doesn't care about your cost basis, your profit target, or how smart you are. It doesn't care that you've been right for months. It doesn't care about your plans or your hopes or your needs. It only cares about supply and demand. And when demand is exhausted, when there are no more buyers, when the professionals have finished distributing their positions to the eager public, price falls. Period. No exceptions. No mercy. Just the cold mechanical reality of supply and demand. Now, you might be thinking, if even you made that mistake, if even someone who understands the tape and the patterns and the psychology made that mistake, how am I supposed to avoid it? That's exactly the right question. And the answer is not in being smarter or having more willpower. The answer is not in being more disciplined or more experienced. The answer is in knowing what to look for, in having a mechanical system of observation that removes emotion from the equation, in recognizing the signs early enough that you can act before hope takes over. Let me tell you about October 1929. Everyone knows about the crash. Everyone's heard about Black Thursday and Black Tuesday. Everyone knows fortunes were lost. But most people don't know the sign I saw that confirmed the top was in. Most people don't know what told me it was time to not just get out, but to go short and profit from the collapse that was coming. I was getting my shoes shined outside my broker's office on a Tuesday morning. The boy shining shoes, couldn't have been more than 16 years old, looked up at me and said, "Mr. Livermore, what do you think of Radio Corporation?" I've got 12 shares on margin. My cousin says it's going to $500 a share. I stopped reading my newspaper. I looked at this kid, 16 years old, shining shoes for tips, and he was buying stocks on margin. I asked him, "How long have you been trading?" "3 months," he said, proud as could be. "I've made almost $60. My cousin got me started. He works for a broker downtown. Says everyone's getting rich. Says this is the new era." I asked him another question. What happens if the stock falls? What happens if Radio Corporation doesn't go to 500? What happens if it goes to 200 instead? He looked at me like I was crazy, like I just suggested the sun might not come up tomorrow. "Why would it fall, Mr. Livermore? Everyone's buying. The market goes up every day." My cousin knows a broker who says the fundamentals have never been better. Says we're in a permanent plateau of prosperity. That's what the experts are saying. Permanent plateau of prosperity. I tipped him double, walked straight into my broker's office, and immediately began liquidating every long position I had. Then I started establishing short positions, large short positions in the stocks that had run the furthest, that were the most owned by the public, that were the most overextended. Why? Why did a shoeshine boy buying 12 shares on margin make me completely reverse my position? Because when shoeshine boys are buying on margin, there's no one left to buy. Think about it. The pool of available buyers is exhausted. Every amateur with any access to credit is already in. Every person who can scrape together any money, who can borrow from their broker or their bank or their family, has already bought. The lawyers have bought. The doctors have bought. The factory workers have bought. The shop owners have bought. And now the shoeshine boys are buying on borrowed money. There is no one left. And when there's no one left to buy, when the last wave of demand has entered the market, there's only one direction price can go: down. Not because of bad news, not because of some external shock, but because there are no more buyers. The rally needs constant new buying to sustain itself. It needs fresh money coming in every day. And when that fresh money is exhausted, when everyone who's going to buy has already bought, the rally ends. Mechanically, inevitably, without exception. This wasn't wisdom. This wasn't genius. This wasn't some special gift I had. This was simple, mechanical observation. I understood that markets are driven by supply and demand. I understood that rallies need buyers. And I understood that when the shoeshine boys are buying on margin, you've reached the bottom of the barrel. You've scraped the last available dollar out of the economy. That shoeshine boy wasn't a sign. He wasn't a leading indicator. He was the confirmation. The market had already been showing distribution for weeks before I ran into him. Professional traders had been selling for months. The tape had been deteriorating. Volume patterns had been shifting. Leadership had been changing from quality stocks to garbage. All the signs were already there. He was simply the final piece of evidence that the crowd had arrived, that the public was all in, that the fuel for the rally was completely exhausted. 3 weeks later, the market crashed. And it wasn't a small correction. It wasn't a healthy pullback. It was a complete collapse. Billions of dollars in value evaporated. Grown men wept in the streets. Suicides were reported in the newspapers. Fortunes that had been built over years were destroyed in days. And I made millions on my short positions. Not because I was lucky, not because I had some inside information, but because I understood the mechanics of markets, and I was willing to act on what I observed, even when it contradicted what everyone else believed. Now let me tell you about a different kind of trader, a man who represents the opposite approach. I'll call him Henderson. I met Henderson in 1925. He was a professional money manager. He managed accounts for wealthy families, old money, conservative money, people who had been rich for generations and intended to stay that way. Henderson was extremely conservative, extremely disciplined, almost cautious to a fault. We were discussing the market in early 1929. By this time, everything was roaring. Stocks were going straight up. Everyone was making money. New millionaires were being created every week. The newspapers couldn't print enough positive stories. Brokers couldn't open accounts fast enough. Henderson had been selling since late 1928, liquidating positions, taking profits, moving to cash. He'd missed enormous gains. Stocks he'd sold at what looked like good prices had doubled and tripled after he got out. His clients were grumbling. Some were openly complaining. A few had even left him for more aggressive managers who were fully invested in riding the wave higher. I ran into him at a club. We had a drink. I asked him, "Henderson, don't you feel like you're leaving money on the table? Don't you feel foolish watching these stocks go higher after you sold them? Everyone else is making fortunes. Your clients are leaving you. Don't you want to get back in?" He looked at me with these calm, steady eyes, and he said something I'll never forget. "Jesse, I'd rather be out of the market wishing I was in than in the market wishing I was out. I don't know when this will end. No one does. No one can predict the exact top, but I know it will end. Every bull market ends. Every rally exhausts itself eventually. And when it does, when this market finally turns, my clients will still have their capital. They'll still have their wealth intact. They'll be scared, sure. They'll be nervous about the future. But they'll have money to invest when opportunities arise. The ones who left me to chase these gains, they'll come back. They always do. I've seen this before. But their capital won't come back. That will be gone." I respected his discipline. I admired his conviction. But privately, I thought he was too cautious. I thought he was leaving too much money on the table. I was making millions on the upside at that time. I was riding the rally, playing the momentum, taking profits and reinvesting them. Henderson was sitting in cash, earning nothing, watching from the sidelines while everyone else got rich. Then October came. The crash, the panic, the absolute destruction. I ran into Henderson again in November. The market had been in free fall for weeks. Stocks that had been at all-time highs were down 50, 60, 70%. Margin calls had wiped out thousands of traders. Brokerage firms were going bankrupt. Banks were failing. The newspapers were full of stories about financial ruin. I saw Henderson walking down Wall Street. He looked calm, almost serene, like he was taking a pleasant afternoon stroll while everyone around him was panicking. I stopped him. "Henderson," I said, "how are you? How are your clients?" He smiled. "They're calling me, Jesse. Every day. They're calling, asking if there are bargains yet, asking if it's time to start buying. They're intact. They're scared, of course. Everyone's scared. But they're intact. They have their capital. They have their wealth. They can wait. They can be patient. They can deploy their money when the time is right. How about your clients, Jesse?" I had to admit the truth. Many of them were devastated. Some were completely wiped out. The ones who'd made the most money in the rally, who'd been the most aggressive, who'd used the most leverage, they'd lost everything. They'd made millions on paper and lost it all, plus more. They owed money they didn't have. Their lives were destroyed. And it was my fault for not forcing them to take profits, for not making them listen when I started seeing the warning signs. Henderson taught me something crucial that day, something I should have already known but needed to relearn. Being early is not the same as being wrong. In speculation, in the market, survival is more important than perfection. It's better to exit too soon and preserve your capital than to wait for the absolute top and risk everything. It's better to take your profits early and miss the last bit of the rally than to hold for the maximum gain and watch it all evaporate in a crash. Henderson's clients thought he was a fool in September of 1929. They thought he was too conservative, too cautious, too worried about risks that would never materialize. But in November they were calling him a genius. They were thanking him for his discipline. They were grateful he'd forced them out when they wanted to stay in. And the aggressive managers they'd left him for? Those managers lost their clients' money and their own reputations. Some never recovered. Now I'm going to shift from stories to principles. I've told you what happened to specific people in specific situations. Now I want to give you the underlying laws, the mechanical truths that appear before every crash. The patterns that repeat because human nature doesn't change. These aren't theories. These aren't guesses. These are observations from 40 years of watching markets, from living through every kind of boom and bust, from making and losing fortunes. The first principle, the foundation of everything, is this. The tape tells the truth before the news does. Price action reveals everything. The tape, which is just the record of transactions, the history of buying and selling, speaks the truth, while newspapers and analysts and experts lie or lag behind reality. Before every crash, before every major market turn, the tape changes character. And if you know how to read it, if you know what to look for, You'll see the crash coming weeks or even months before it happens. Here's what I watch. Sign number 1. Deteriorating quality of rallies. In a healthy bull market, rallies are decisive, strong, confident. Prices gap up at the dollar tees. Open. They stay strong all day. They close at or near the high of the day. Volume is heavy on the upside. Buyers are aggressive. There's enthusiasm, but it's backed by real accumulation, by real money coming in and staying in. When I see rallies that open strong but fade by midday, that's a warning sign. When I see late day selling that erases morning gains, that's a warning sign. When I see prices struggling to hold advances, when they rally $1 and give back 80 cents, that's exhaustion. That's demand dying. The crowd sees a rally, any rally, and thinks the bull market continues. They think as long as prices are going up at all, everything is fine. I see a rally that can't hold, that can't maintain its gains, that fades under its own weight, and I know that demand is dying. I know that the buyers are getting weaker, that they're losing conviction, that they're not willing to hold their positions. Sign number 2. Increasing volume on down days, decreasing volume on up days. This is purely mechanical. Volume represents conviction. It represents how many shares are changing hands, how much money is flowing in or out. When volume expands on declines and contracts on advances, it means sellers are more motivated than buyers. It means people are more eager to get out than to get in. It means the professionals are distributing. They're selling their positions to the public, and the public hasn't realized it yet. Most traders ignore volume. They watch price and nothing else. They see a stock at $60 and think that's all the information they need. Price is what happened. Volume is why it happened. Volume tells you the conviction behind the price movement. A stock can go from 60 to 65 on light volume, meaning only a few transactions at those prices, or it can go from 60 to 65 on heavy volume, meaning massive accumulation. Those are two completely different scenarios with completely different implications. Learn to read volume. Compare the volume on up days to the volume on down days over a period of weeks. If down volume is consistently heavier than up volume, you're watching distribution. You're watching professionals get out. And you should be getting out too. Sign number 3. Leadership changes. In every bull market, certain stocks lead. These are the strongest companies, the best balance sheets, the most heavily accumulated by professional money, the stocks that institutions own, quality stocks. They lead because smart money buys them first and holds them longest. When those leaders stop going up, when they start lagging the market, when they start showing relative weakness, that's a massive warning sign. And when weaker stocks, more speculative stocks, lower quality stocks start leading, that's confirmation that the market is rotting from the inside. Here's why this matters. The public always chases performance. They look at what went up the most yesterday, and they buy it today. So when the quality stocks stop going up, the public looks around for what is still going up. And what's still going up at that point? The garbage, the speculation, the stocks with no earnings, questionable business models, excessive debt, the stocks that professional money would never touch. The public piles into these stocks because they're moving, and professionals step aside or actively short them because they know this is the final stage. When garbage leads and quality lags, the end is near. Not next year, not next quarter, soon. The deeper meaning of all this is simple. Markets speak in patterns, not words. They don't send you a letter telling you the top is in. They don't announce that the crash is coming. They show you through price and volume and leadership. Your job as a speculator is not to predict the future. You can't predict the future. No one can. Your job is to observe the present with absolute clarity, to see what's actually happening right now, not what you hope is happening or what you fear is happening. The tape shows you everything: accumulation or distribution, strength or weakness, conviction or hope, real buying or artificial manipulation. Learn to read it without emotion, without bias, without letting your positions influence your interpretation, and you'll never be blindsided by a crash. Now let me talk about the public. Understanding the public is critical because the public is always wrong at extremes. Every market cycle follows the same pattern. It's so predictable it's almost boring once you've seen it enough times. Phase 1. Professionals accumulate quietly while prices are low and sentiment is negative. This is when the newspapers are full of doom and gloom, when everyone thinks the market will never recover, when ordinary people are swearing they'll never invest again. That's when professionals are buying, quietly, patiently, without fanfare. Phase 2. Prices begin rising. The decline has stopped. A base has formed. Early adopters, people who are watching the tape and seeing accumulation, start entering. The move gains momentum. It's still quiet. The public isn't paying attention yet. But the trend has changed from down to up. Phase 3. The public notices. They've been watching from the sidelines. They've been burned before and they were scared. But now they see prices going up day after day. They see their friends making money. Media coverage increases. Financial news goes from pessimism to cautious optimism, and the fear of missing out begins to take over. This is a powerful emotion. This fear of watching everyone else get rich while you stand on the sidelines. It overrides logic. It overrides caution. Phase 4. The public goes all in. This is the critical phase. This is where the top is made. The public doesn't just buy. They buy with borrowed money. They open margin accounts. They take out home equity loans. They cash out retirement accounts. They're all in. They're convinced this time is different. They're certain the rally will continue forever. This is the top. Not when they start buying. When they're fully committed. When there's no more money left to invest. When they've exhausted every source of capital. Phase 5. Professionals distribute into the public buying. While the public is enthusiastically accumulating, professionals are selling. Every share the public buys at the top was sold to them by a professional. The rally continues for a while on this public buying. Prices might even make new highs. But it's artificial. It's not genuine accumulation. It's distribution disguised as accumulation. And then the buying exhausts itself. There's no one left. And the crash begins. Why does this happen every single time? Why does the pattern repeat in every market, in every era, in every country? Because the public operates on emotion and information lag. By the time the crowd believes the rally is safe, by the time they're convinced and comfortable and fully invested, it's over. The professionals knew months ago. They were watching the tape. They were seeing the early signs. They started distributing slowly, carefully, into the public enthusiasm. And by the time the public is all in, the professionals are all out. Here's what I watch for. When strangers at social gatherings ask me for stock tips, I know we're near the top. When taxi drivers and waiters tell me what they're buying, I know the public is fully committed. When people who've never invested, who know nothing about markets, start opening brokerage accounts, the cycle is complete. When I hear phrases like "this time is different" or "we're in a new era" or "the rules have changed," I know it's time to sell. This isn't snobbery. This isn't elitism. This is pure mechanics. Markets rise when there's more buying than selling. That's it. That's the only thing that makes prices go up. More demand than supply. When everyone who's going to buy has already bought. When the shoeshine boys are buying on margin, there's no fuel left for the rally. The engine sputters and dies. The rally stalls, then reverses, then crashes. What this means for you is critical. If you're feeling comfortable with your positions right now, if everyone around you agrees the market is going higher, if you're certain this time is different, you're probably the public. You've probably arrived late. And the public always loses because they arrive last and refuse to leave. They buy at the top and hold through the entire decline, paralyzed by hope, unable to accept that they were wrong. Now let's talk about leverage. This is crucial. Margin debt, borrowed money used to buy stocks, is gasoline on a fire. It amplifies everything. It amplifies gains on the way up and accelerates destruction on the way down. Here's exactly how it works and why it's so dangerous. When markets are rising, traders borrow money to increase their positions. Let's say you have $10,000. You could buy $10,000 worth of stock. Or you could use margin and buy $20,000 or even $30,000 worth of stock. You're borrowing the difference from your broker. This borrowed money creates additional buying pressure. It pushes prices higher. And as prices go higher, people who are on margin make even more money because they're controlling more shares than they could have bought with cash. This success breeds more borrowing. If you made 50% on 20,000 borrowed, why not borrow 40,000? Why not borrow 100,000? The rally feels unstoppable. It feels like you've discovered the secret to unlimited wealth, and it's all being artificially amplified by leverage. But here's what happens when prices start to fall. When you're on margin, you don't own the stock outright. The broker owns part of it. They lent you the money with the stock as collateral. And brokers have rules. They require you to maintain a certain level of equity in your account. When prices fall, your equity falls. And when your equity falls below the required level, you get a margin call. The broker calls you and says, you need to add more capital to your account. You need to deposit more cash. If you don't, we're going to sell your positions. We're going to liquidate everything to get our money back. Most people can't add capital. They don't have extra cash sitting around. They already invested everything they had. So their positions get sold, automatically, mechanically, without regard to value or fundamentals, or whether it's a good price. The broker just sells, and this forced selling pushes prices lower, which triggers more margin calls at other brokerage firms, which creates more forced selling, which pushes prices even lower. It's a cascade, a waterfall, a self-reinforcing spiral of destruction. The crash of 1929 was so severe, so total, so devastating, not because the economy collapsed overnight. The economy was actually still functioning in October of 1929. The problem was that the entire market was leveraged. Everyone owed money. When prices started falling, everyone got margin calls. Everyone had to sell, and the selling fed on itself like a fire burning through a dry forest. There were no natural buyers. Everyone was trying to sell at the same time. Bids disappeared. You'd try to sell a stock that had been at $100 and find there were no buyers at 90, no buyers at 80, no buyers at 70. You'd finally get executed at $50 and feel grateful. That's what leverage does in a crash. The warning sign you need to watch is margin debt levels. This is public information. It's reported. When margin debt is at record highs, when borrowing is at extremes, the market is fragile. It's built on a foundation of debt, and one bad day can trigger a cascade that feeds on itself. You cannot control what others do. You can't stop other traders from borrowing, but you can control your own leverage. The professionals I know, the ones who've survived for decades, the ones who are still wealthy, they use little to no leverage. They buy with cash. They can hold through volatility without being forced out. They survive crashes, and they have capital to buy the aftermath when stocks are on sale. The amateurs use maximum leverage. They borrow everything they can. They make the most money in the rally, and they lose everything in the crash. Don't be the amateur. Now I need to talk to you about hope. This might be the most important thing I tell you today. I've lost more money to hope than to any other emotion, more than to fear, more than to greed, more than to impatience. Hope is the most expensive emotion in speculation. Hope makes you hold losing positions. Hope makes you ignore warning signs. Hope makes you believe it will come back. And hope destroys more traders than any market crash ever could. Let me be absolutely clear. Hope is not a strategy. Hope is what you feel when you've made a mistake and refuse to accept it. Hope is what takes over when you should be cutting your losses and moving on. Here's the pattern of hope. You buy a stock at $50. It goes to 60. You feel smart. You feel validated. You think you've figured it out. It tops out at 60 and starts declining. 60 to 58. 58 to 55. You think it's just a pullback. You think it's a natural correction. It's healthy. You tell yourself. It'll resume the uptrend soon. It keeps falling. 55 to 52. 52 to 48. Now you think it's a buying opportunity. It's on sale. You should buy more. Average down. Lower your cost basis. Your profit has turned into a small loss. Bought at 50. Now at 48. Down 4%. No big deal. You think it will recover. It has to recover. It was at 60 just a few weeks ago. The loss deepens. 48 to 44. 44 to 40. Down 20% now. You can't sell now. That would make the loss real. If you just hold, it might come back. And if it comes back, you'll be fine. You'll be whole again. So you hold. You're paralyzed. Every day you check the price. Every day it's lower. Every day the pain increases. And every day you can't bring yourself to sell because selling would mean admitting you were wrong. Selling would mean accepting the loss. 40 to 35. 35 to 30, down 40% now. Your stomach hurts when you think about it. You can't sleep. You're angry at yourself, at the market, at the company, at everything. But you still hold, because you hope. You hope it will come back. And while you hope, the position destroys your capital. That capital could have been redeployed into a better opportunity. It could have been used to buy something that's actually going up. Instead, it's trapped in a losing position because you're hoping. I've done this. Every trader has done this. It's part of being human. The difference between amateurs and professionals is that professionals learn to cut losses before hope takes over. They learn to act while the loss is small and manageable. They learn to be wrong quickly and move on. The rule is simple but incredibly hard to follow. Set your exit point before you enter the position. Before you buy, decide where you'll sell if you're wrong. Write it down. Make it mechanical. And this exit point cannot be based on hope or pain tolerance. It can't be based on how much loss you're willing to take. It has to be based on what the market tells you. If the position violates your thesis, why you bought it in the first place, exit immediately. If the tape shows weakness, distribution, deteriorating leadership, exit. If volume patterns shift from accumulation to distribution, exit. If you're holding because you hope it will recover, because you can't accept the loss, because selling would hurt your ego, you're gambling. You're not speculating. You're not trading. You're gambling on hope. And hope is a guaranteed way to lose. Why is this so hard? Because selling at a loss feels like admitting defeat. It feels like you're saying, I was wrong. I made a mistake. I'm not as smart as I thought. Your ego fights against it. Your pride fights against it. You tell yourself you're not a quitter. You tell yourself patience is a virtue. You tell yourself successful traders hold through volatility. But there's a difference between holding a position that's working and hoping a position will recover. There's a difference between patience based on thesis and hope based on denial. In speculation, quitting a bad position is not weakness. It's discipline. It's intelligence. It's survival. Capital preservation is more important than being right. I would rather take 10 small losses in a row than hold one position through a 50% decline. Because small losses can be recovered. Large losses are devastating. They put you out of the game. The professionals I've known all share one trait. They can admit when they're wrong and act immediately. They don't hesitate. They don't hope. They cut the loss and move on to the next opportunity. The amateurs I've watched lose fortunes all share one trait. They hold and hope. They can't admit they're wrong. They can't take the loss, and it destroys them. Now I'm going to tell you something that might shock you. Something that contradicts everything you hear from analysts and financial media. Fundamentals lag. Price leads. This is one of the most dangerous lies in speculation. The idea that stocks fall because fundamentals deteriorate. It's not true. The truth is the opposite. Stocks fall first. Then fundamentals deteriorate later. The market knows before the news knows. In 1929, the fundamentals looked perfect in September. Corporate earnings were strong. The economy was growing. Production was up. Employment was high. There was no reason, no fundamental reason, for stocks to crash. But they did. Why? Because price doesn't wait for news. Price discounts the future. Price moves first, news comes later. How does this work? Professional traders and insiders, the people who are actually running companies or have close relationships with management, they know what's coming before it's reported. They see orders slowing down. They see customers becoming cautious. They see inventory building up. They see demand weakening. This is happening in real time, right now, before it shows up in any financial report. And they act on this information. They start selling, not all at once, not in a way that's obvious, but gradually, quietly, they're distributing their positions. Meanwhile, the public is reading last quarter's earnings report. They're looking at data that's 3 months old. They're listening to analysts who are looking at historical data. They see strength. They see growth. They think everything is fine. So they keep buying. By the time the bad news is official, by the time the earnings report shows the decline, by the time the newspapers report the weakness, the stock has already fallen 30 or 40%. The professionals sold near the top to the public. The public held through the entire decline. waiting for the fundamentals to confirm what the price was already telling them. The implication is clear. You cannot wait for confirmation from fundamentals. If you wait for the news to tell you to sell, you're selling at the bottom while professionals are buying. You must learn to read price action and volume as early warning signals. You must trust what the tape is telling you even when it contradicts the official narrative. This doesn't mean fundamentals don't matter. Long-term fundamentals matter enormously, but fundamentals lag. They tell you what happened, not what's happening. Price leads because price reflects the aggregate knowledge of all market participants, especially those with the best information. Think about it logically. Who knows more about a company's future? You, reading quarterly reports in your living room? Or the CEO, the CFO, the major shareholders, the industry competitors, who are seeing the same trends? They know first, and they act first. By the time you know, it's too late. The takeaway is this: stop waiting for reasons. Stop demanding explanations. Stop needing the news to confirm what you're seeing. The market doesn't owe you clarity. It doesn't owe you understanding. It gives you price and volume. That's it. That's all you get. Learn to trust those signals, even when they contradict the narrative everyone else believes. Learn to act on what you observe, not on what you read. Now I'm going to tell you the most important concept I can teach you. The concept that, if you understand it and internalize it, will protect you from every crash. Crashes are built during rallies. The crash doesn't begin when prices fall. The crash begins during the rally, when the conditions for collapse are being constructed brick by brick. Think of it like a building with a weak foundation. The cracks form during construction. The structural problems are being created while the building is going up, but the collapse happens later. The building looks fine for a while. People move in. They live and work there. Everything seems solid. And then one day, the building falls. By the time everyone sees the building falling, it's too late to get out. They're trapped inside. The market works the same way. During a rally, especially in the later stages, watch for these conditions being built, excessive leverage being taken on, which we already discussed, public participation increasing, which means the last buyers are arriving, professional distribution hidden by rising prices, which means smart money is selling to dumb money, speculation in weak, low-quality stocks, which means money is chasing anything that moves, breadth diverging from price, which means fewer stocks are participating in the rally even though the indices are still going up. These are not signs of an imminent crash. These are the crash being built. These are the conditions that make the crash inevitable. The actual collapse is simply the result of these conditions. It's the effect, not the cause. Why does this matter? Because if you wait for prices to fall before you act, you're reacting to the collapse, not anticipating it. And when you're reacting, when everyone else realizes at the same moment that something is wrong, you're in trouble. Liquidity dries up instantly. Everyone wants to sell. No one wants to buy. Bids disappear. You're trapped. You can't get out at a reasonable price. You have to accept whatever price you can get. The time to exit is during the rally, when you can still sell at good prices, when there are still eager buyers, when liquidity is abundant, when you can get out smoothly without panicking. Sell too early, and you miss some profit. Fine. You still made money. You're still in the game. You preserved your capital. Sell too late and you lose capital. Maybe a lot of capital. Maybe everything. I'll take early over late every single time. Every single time. I would rather leave money on the table than lose money hoping for a few more % of gain. Now let's talk about the crowd. About mass psychology. About why the majority is always wrong at extremes. Speculation is not a popularity contest. The goal is not to agree with everyone else. The goal is not to be part of the consensus. The majority is always wrong at turning points. Always. Without exception. Because the majority operates on emotion, not observation. They operate on feelings, not facts. At market tops, everyone is bullish. I mean everyone. Sentiment surveys show extreme optimism. Bulls outnumber bears 10 to 1. Analysts raise their price targets. They come out with these ridiculous projections. Stock that's at 100 is going to 150, they say. Maybe 200. The media celebrates the boom. Look how much wealth is being created, they say. Look at all these new millionaires. This is not a sign of strength. This is a sign that the last buyers have arrived. At market bottoms, it's the opposite. Everyone is bearish. Panic is universal. Fear dominates. Sellers are desperate. They'll take any price just to get out. They want the pain to stop. Media predicts the end of capitalism. The market will never recover, they say. This is the new normal. And this is not a sign of weakness. This is a sign that the last sellers have capitulated, that everyone who was going to sell has already sold, that the decline has exhausted itself. The contrarian principle is this: your job is not to think differently for the sake of being different. Being a contrarian, just to be contrarian, is stupid. Your job is to observe what the crowd is doing and recognize when their behavior creates opportunity. When the crowd is euphorically buying, when everyone is certain prices are going higher, ask yourself one question: who's left to buy? If everyone is already in, if everyone is already fully invested, who's going to push prices higher? There's no one left. When the crowd is panicking and selling, when everyone is certain the decline will never end, ask yourself another question: who's left to sell? If everyone who was going to sell has already sold, if all the weak hands have been shaken out, what's left? Only buyers. Crashes happen when the crowd is most certain the rally will continue, when confidence is at its peak, when fear has been completely forgotten. That's when they happen. Not when people are nervous, not when there's healthy skepticism, when there's complete certainty that nothing bad can happen. Bottoms form when the crowd is most certain the decline will never end, when despair is total, when hope has been abandoned. That's when bottoms form. Now I'm going to give you specific, actionable steps you can take immediately to protect yourself and position yourself to profit when the crash comes. Because it will come. Maybe, not tomorrow, maybe not next month, but it will come. Every market that goes up comes down. Every rally ends. Every bubble pops. And you need to be prepared. Every morning before the market opens, I perform the same analysis. I've been doing this for 40 years. This takes me about 15 minutes. It's not complicated. There's no advanced mathematics. There's no sophisticated software. It's just disciplined observation. Step 1. Review the leaders. I identify the 10 to 15 stocks that have been leading the market higher. The strongest performers, the ones everyone is watching. I check their overnight performance if there's been international trading. I watch their opening price action. Are they gapping up at the open with strong volume? Are they holding their gains through the first 30 minutes? If the leaders are weak, if they're opening lower or fading after opening higher, the market is weak. I don't care what the indices show. If the leaders are weak, the market is weak. Step 2. Check volume patterns. I compare yesterday's volume on up moves versus down moves. Not just total volume, but volume in relation to price movement. If prices rose but volume was light, that's weak. If prices fell and volume was heavy, that's distribution. I note this pattern over several days, over several weeks. If selling volume consistently exceeds buying volume while prices are still rising or staying flat, distribution is occurring. This is professionals selling to amateurs. This is the smart money exiting. And when I see this pattern persisting, I reduce my exposure. I take some chips off the table. Step 3. Observe market breadth. How many stocks are participating in the rally? You can look this up. You can see how many stocks advanced versus how many declined. If the index is rising but fewer stocks are advancing than declining, if breadth is negative, the rally is narrowing. It's being held up by fewer and fewer stocks. This is a warning sign. This is like a pyramid balancing on its point instead of its base. It's unstable. It can't last. Step 4. Read the opening action. I watch the first 30 minutes of trading very carefully. This tells me who's in control. Buyers or sellers, professionals or amateurs. Strong markets gap up at the open and hold the gains or extend them through the morning. Weak markets gap up and then fade. They give back the opening gains. They close lower than they opened. Pay attention to whether the enthusiasm is real or artificial. Is there genuine buying pressure all day? Or is it just opening excitement that evaporates? Make this ritual non-negotiable. Do this every single day the market is open. It takes minutes, maybe 15 minutes, and it will save you from holding through crashes because you'll see the deterioration before the crowd does. You'll see the signs weeks before prices actually fall. Now let me talk about position sizing and exit rules. Most traders lose not because they pick bad stocks, but because they risk too much on each position. They're all in when they should be cautious. They're fully invested when they should be in cash. Here's how I manage risk and how you should think about it. Step 1. Size positions based on market conditions. In strong, healthy bull markets, when I see clear leadership, when breadth is expanding, when volume confirms price movement, when all the conditions are right, I'm comfortable with larger positions. But even then, never more than 10 to 15% of my total capital in any single position. Never. I don't care how certain I am. I don't care how good the opportunity looks. Never more than 10 to 15% in one stock. Because I'm wrong sometimes. Everyone is wrong sometimes. And if I have 50% of my capital in one stock and I'm wrong, I'm in serious trouble. As warning signs appear, as I start seeing the distribution we talked about, as leadership weakens, as breadth narrows, I reduce position sizes. I go from 10% positions to 5% positions. I raise more cash. When multiple danger signs are present, when several of these warning indicators are flashing, I'm in 50% cash or more. I'm defensive. I'm protecting capital. The public does the opposite. They get more aggressive as the top approaches. Why? Because they're making money. Because they're feeling confident. Because everything they touch is going up. So they increase their bets. They take bigger positions. They use more leverage. And this is how they get destroyed. They're at maximum risk at the moment of maximum danger. Step 2. Set mechanical stops. Before entering any position, before you buy a single share, decide the price at which you'll exit if you're wrong. This is not optional. This is mandatory. Write it down. Put it in your trading journal. Put it on a sticky note on your monitor. And honor it. Don't move it. Don't adjust it. Don't give the position more room because you hope it will come back. Your stop should be based on what the market tells you, not on how much loss you're willing to take. If a stock breaks below key support, get out. If volume patterns shift from accumulation to distribution, get out. If the thesis you bought on is violated, get out. Don't wait for the pain to become unbearable. Don't wait until you're down 30%. Act when the sign appears. Step 3. Take partial profits into strength. When positions have given you significant profit, when you're up 30, 40, 50%, and warning signs are appearing in the broader market, take some profit off the table. You don't have to sell everything. Sell half. Sell a third. Lock in gains. Reduce your risk. If the stock keeps going up, you still have some exposure. If it falls, you've preserved some of your profit. The public holds because they're greedy, because they want every last dollar of profit, because selling feels like giving up. Professionals take profit because they know bull markets end, because they know that paper profits are not real until you sell, because they'd rather have money in the bank than hope in their account. Be the professional. Now, keep a simple journal. I want you to do this every single weekend, every Saturday or Sunday. Sit down for 30 minutes and answer these questions. Question 1. What did the market show me this week? Not what you think about the market, not what you hope, not what analysts said. What did price and volume actually show you? Did the leaders lead? Did volume confirm price? Was breadth expanding or contracting? Just observe and record. Question 2. Are the leaders still leading? Make a list. Write down the top 5 or 10 performers. Are they the same stocks that led last month? Last quarter? If leadership is rotating to weaker stocks, to more speculative names, to low-quality companies, note it. This is important. Question 3. How is my psychology? Are you feeling confident, anxious, greedy, fearful, impatient? Your emotions are data. When you're most comfortable, when you're most certain, you're probably most at risk. When you're most fearful, most uncertain, opportunities are probably present. Question 4. What's the crowd doing? Are people around you talking about the market? Are friends asking for stock tips? Are new traders entering? Is media coverage intensifying? Are there more financial news stories? These are signs of public participation, and public participation means the cycle is maturing. Question 5. What's my plan if I'm wrong? If the market reverses next week, do you know what you'll do? Have you decided in advance? If you don't have a plan, make one now. Don't wait for the crisis. Don't wait for the panic. Decide now, calmly, rationally, what you'll do if conditions change. This journal is not for prediction. You're not trying to predict the future. You're trying to observe the present with clarity. Over time, you'll see patterns. You'll see how market behavior changes at different stages of the cycle. You'll see how your own psychology changes. And this awareness, this self-knowledge, combined with market knowledge, is the foundation of discipline. Now, I want to give you a practical tool to identify when professionals are selling to the public. This is simple. Anyone can do this. Create a tracking sheet. It can be a piece of paper. It can be a spreadsheet. Whatever works for you. Make 3 columns. Column 1, stock or index. Write down the stocks you own or the indices you're watching. Column 2, volume on up days. For the last 5 days, calculate the average volume on days when the stock went up. Column 3, volume on down days. For the last 5 days, calculate the average volume on days when the stock went down. Every week, update this sheet. Just 5 minutes. Look at the volume data and update your averages. When column 3 consistently exceeds column 2, when down volume is heavier than up volume, week after week, while prices are still rising or flat, distribution is occurring. This is your signal. This is the market telling you that professionals are selling, that smart money is exiting, and you should be reducing exposure. You don't need sophisticated software. You don't need expensive data feeds. You don't need algorithms. You need consistent observation. You need discipline. The market will tell you when it's under distribution. It will show you through volume. You just have to look. You just have to pay attention. Now, right now, today, before you do anything else, I want you to do this exercise. Review every position you own, every single one. Look at your account. Look at your holdings. And for each position, ask yourself this question. If this stock fell 20% tomorrow, if it gapped down 20% on some news or for no reason at all, would I still want to own it? Would I be comfortable holding it? Would I add to it? Or would I want to sell? Be honest. Don't lie to yourself. If the answer is no, if you wouldn't want to own it down 20%, sell some or all of it now, today. Don't wait. Because if you're uncomfortable owning it down 20%, you're going to panic if it actually falls, and panic leads to mistakes. Identify your maximum acceptable loss. Sit down and think about this. How much of your capital are you willing to lose in a market crash? 10%? 20%? Be realistic. What number would devastate you? What number would keep you up at night? What number would make you sick? Once you know this number, position yourself so that even a severe market decline won't exceed it. If you can only tolerate a 10% loss, you shouldn't be fully invested. You should be in enough cash that a 30% market decline only costs you 10%. Build a cash reserve. I can't stress this enough. Cash is not cowardice. Cash is not missing out. Cash is ammunition. Cash is opportunity. The traders who profit most from crashes, who build enormous wealth from market collapses, are those who have capital to deploy when prices crater. When everyone else is panicking and selling and desperate, they're calmly buying at bargain prices. But you can only do this if you have cash. If you're fully invested, if you're on margin, you're vulnerable. You're at the market's mercy. You have no options. Build cash now, while you can sell at decent prices. Write down your action plan. Get a piece of paper. Write this at the top. If the market drops 10% next week, I will. And then, fill in specifically what you'll do. Will you sell everything? Will you sell half? Will you hold? Will you buy more? Decide now, in calm, while you're rational, so you're not deciding in panic when fear takes over. This preparation doesn't guarantee profit. It doesn't guarantee you'll time the top perfectly, but it guarantees survival. And in speculation, survival is success. The traders who last for decades, who build lasting wealth, are not the ones who made the most in any given rally. They're the ones who survived the crashes, who preserved capital, who lived to trade another day. Listen to me. We've covered a lot in the last hour and 20 minutes. I've told you stories of men who lost fortunes because they couldn't see what was right in front of them. Martin, who held through the crash because he couldn't accept that fundamentals weren't enough. Myself, losing $4 million because my ego wouldn't let me admit I'd overstayed. The shoeshine boy, buying on margin, signaling the absolute exhaustion of buyers. Henderson, getting out early and preserving capital while others chased the last gains and lost everything. I've given you principles that have held true through every boom and bust I've lived through. The tape tells the truth before the news does. The public arrives last and loses first. Leverage amplifies crashes. Hope destroys capital. Fundamentals lag price. Crashes are built during rallies. The crowd is always wrong at extremes. And I've given you practical steps you can take starting today. Daily tape reading ritual. Position sizing based on market conditions. Mechanical stops. Partial profit taking. Weekly journaling. Distribution detection systems. Pre-crash preparation protocols. But here's the truth. None of this matters if you don't act on it. You can know all of this intellectually. You can understand every principle. You can agree with every word I've said, and you can still lose everything if you don't act, because knowing and doing are completely different things. The market right now is showing many of the signs I've described. I'm not saying a crash is coming tomorrow. I'm not making predictions about specific dates. I don't know when. No one knows when. But I'm saying the conditions are present. The leverage is extreme. The public is heavily invested. Leadership is questionable. Volume patterns are diverging. The signs are there. You have a choice. You can ignore these signs because everyone around you is still bullish, because the news is still positive, because your positions are still making money, because selling feels like giving up, like admitting defeat, like missing out. That's what the crowd does. That's what the public does. And the crowd gets destroyed. Or you can observe. You can reduce exposure. You can take some profit. You can build cash. You can prepare. You can position yourself so that if I'm right, if the crash comes, you survive. You preserve capital. You have ammunition to buy the aftermath. And if I'm wrong, if the market keeps going up, you've simply been cautious. You've missed some gains. But you're still in the game. You still have your capital. There's no shame in caution. There's no shame in survival. There's only shame in knowing the danger and doing nothing. I learned these lessons through pain, through losses that broke me, through watching my account go from millions to nothing, through watching men I respected, intelligent men, successful men, lose everything because they couldn't see or wouldn't act. I'm sharing them with you because you don't have to learn them the hard way. You don't have to lose everything to understand these principles. The market will crash again. This is not pessimism. This is reality. Markets are cyclical. They go up and they go down. Every rally ends. Every bubble pops. Every bull market turns into a bear market eventually. Maybe it happens next week. Maybe next month. Maybe next year. I don't know when, but I know it will happen. And when it does, there will be two groups of people. Those who saw it coming and protected themselves, who reduced exposure, who took profits, who built cash, who preserved capital, who positioned themselves to survive and profit from the chaos, and those who hoped it wouldn't happen, who convinced themselves this time was different, who held their positions because selling felt wrong, who lost. Which group will you be in? That's the only question that matters. Which group will you be in? Start observing. Start paying attention to what the market is actually showing you, not what you hope it's showing you. Start preparing. Start taking action. Start acting like a professional instead of a gambler. Professionals survive. Gamblers get wiped out. The tape is telling you everything you need to know. The volume is there. The leadership changes are there. The distribution is there. The public participation is there. The signs are all there. The question is whether you're willing to listen, whether you're willing to see what's right in front of you, whether you're willing to act on what you see, even when it's uncomfortable, even when everyone else thinks you're wrong. If this resonated with you, if you're ready to learn how to read markets the way professionals do, subscribe to this channel. Hit that subscribe button right now. I'm going to keep teaching these principles, the lessons I paid millions to learn, the truths that never change, the patterns that repeat because human nature doesn't change. This isn't entertainment. This isn't content for the sake of content. This is the work of my life. This is 40 years of experience distilled into practical wisdom. Hit the like button if this challenged the way you think about the market, not because it made you feel good. I'm not here to make you feel good. I'm here to make you think. I'm here to show you reality. Hit like if this changed your perspective, if it made you see something you weren't seeing before. And leave a comment. Tell me, what warning signs are you seeing right now in your positions? What stocks are making you nervous? What's making you check your account with that knot in your stomach? What's your plan if I'm right? What are you going to do if the market drops 10 or 20% next week? I read every comment. Not because I'm obligated to, because I care. Because this isn't just a video to me. This is my life's work, and I want to know if it's reaching the people who need it. I want to know if I'm helping you see clearly. I want to know if you're going to act. Now get to work. Stop watching videos. Stop consuming content. Start observing your market. Start reviewing your positions. Start making your plan. The market won't wait for you to be ready. It doesn't care if you're prepared. It doesn't care if you understand. It's going to do what it's going to do. And when the crash comes, when the cascade starts, when prices are falling and everyone is panicking, it will be too late to prepare. The time to prepare is now, today, this moment. So close this video and get to work. Your capital depends on it. Your future depends on it. Get to work.